Banks are the pillars of our modern economic structure. They underpin financial stability and serve as engines of global development. Their influence permeates every facet of our lives, from the simplest transactions to the most complex financial instruments. This profound impact raises a fundamental question. How did these institutions become so deeply ingrained in the fabric of our society? Our journey begins in the vibrant cities of Renaissance Italy, where the seeds of modern banking were sown. Amidst the flourishing art and culture of the 14th century, families like the Bardi and Peruzzi established financial dominance, extending their reach across Europe through a network of branches. Among these early pioneers, the Medici Bank, founded by Giovanni di Medici in 1397, rose to prominence, exemplifying the growing influence of these family-run institutions. These early banks played a crucial role in facilitating trade, financing ventures, and shaping the economic landscape of their time. In the heart of Florence, a city pulsating with artistic fervour and commercial ambition, the Medici Bank emerged as a financial powerhouse. Founded by Giovanni di Medici in 1397, the bank's ascent mirrored Florence's own rise to prominence during the Renaissance. Unlike their rivals, the Bardi and Peruzzi families, who met their demise through risky loans to European monarchs, Giovanni astutely focused on diversification and prudent lending practices. Giovanni's genius lay in recognizing the burgeoning economic potential of Florence's textile industry. He strategically established branches along the bustling trade routes, catering to the financial needs of merchants and artisans. These branches, strategically located in key cities like Rome, Venice, and Geneva, not only facilitated trade, but also acted as vital information hubs, providing the Medici with invaluable insights into market trends and political developments. Under Cosimo's leadership, the Medici Bank became the financial engine behind Florence's political and cultural dominance. Cosimo, recognizing the symbiotic relationship between wealth and power, strategically used the bank's resources to cultivate political alliances, secure lucrative contracts, and exert influence over the city's affairs. Cosimo's patronage extended far beyond the arts. He generously funded public works projects, beautified churches, and supported charitable institutions. These acts of philanthropy, while undoubtedly driven by a genuine desire to improve the lives of Florentines, also served to enhance the Medici family's popularity and legitimize their growing power within the city-state. The Medici Bank's influence extended far beyond the borders of Florence. Its network of branches spanned across Europe, from the bustling port of Bruges in Flanders to the Papal States in Rome. This expansive reach not only facilitated trade, but also provided the Medici with unparalleled access to information and resources. The Medici Bank's involvement in international trade was vast and varied. They financed the import of luxury goods from the East, such as spices, silks, and precious stones. They also played a key role in the wool trade, providing credit to merchants who purchased raw wool from England and Spain and then sold finished cloth throughout Europe. As Europe transitioned from the Renaissance to the Enlightenment, the world of finance witnessed a profound shift. The burgeoning trade routes, expanding empires, and growing economies demanded a more efficient and secure form of currency than cumbersome gold and silver coins. This need gave rise to a revolutionary concept: banknotes. The story of banknotes begins with goldsmiths, the custodians of precious metals. As individuals deposited their gold with goldsmiths for safekeeping, they received receipts as proof of ownership. These receipts, initially simple acknowledgements of deposit, gradually evolved into a form of payment themselves. Along with the emergence of banknotes came another pivotal development that would shape the future of banking: fractional reserve banking. This system, both ingenious and inherently risky, allowed banks to lend out a portion of their depositors' funds, amplifying their lending capacity and fueling economic growth. The concept behind fractional reserve banking is deceptively simple. Banks, recognizing that not all depositors would withdraw their funds simultaneously, began lending out a fraction of their deposits, keeping only a small reserve to meet daily withdrawal demands. This practice, while seemingly precarious, effectively created new money in the economy, stimulating investment and consumption. Section 3. The seeds of financial innovation, early stock markets and public debt. The 17th and 18th centuries witnessed not only the birth of banknotes and fractional reserve banking, but also the emergence of other financial innovations that would shape the modern financial landscape. Among these innovations were the early stock markets and the development of sophisticated systems of public debt. The world's first stock exchanges, such as the Amsterdam Stock Exchange, established in 1602, emerged as platforms for trading shares in joint stock companies, the precursors to modern corporations. These exchanges facilitated the raising of capital for ambitious ventures, particularly in overseas trade and exploration. Section 1. The rise of central banking, guardians of stability. The 19th and 20th centuries witnessed the rise of central banking, a pivotal development that would fundamentally reshape the financial landscape. Central banks emerged as guardians of stability, tasked with overseeing monetary policy, managing currency, and acting as lenders of last resort in times of crisis. The establishment of central banks was often a response to recurring financial panics and the inherent instability of fractional reserve banking. The Bank of England, founded in 1694, is considered the world's oldest central bank, initially established to finance the English government's war efforts. Over time, it evolved into a model for other central banks, assuming a broader role in ensuring financial stability. Section 2. The Basel Accords, a global framework for financial stability. The latter half of the 20th century witnessed increasing globalization and interconnectedness of financial markets. This interconnectedness, while fostering economic growth and integration, also heightened the risk of systemic financial shocks that could cascade across borders. The need for international cooperation and standardized regulations became increasingly apparent. The Basel Accords, a set of international banking regulations developed by the Basel Committee on Banking Supervision, emerged as a crucial framework for promoting global financial stability. The first Basel Accord, established in 1988, focused on capital adequacy, requiring banks to hold a minimum amount of capital reserves against their risk-weighted assets. Section 3. Navigating the financial crisis, lessons learned and challenges ahead. The global financial crisis of 2008, triggered by a collapse in the US housing market and the subsequent unraveling of complex financial instruments, served as a stark reminder of the inherent fragility of the financial system. It exposed vulnerabilities in banking regulations, risk management practices, and the interconnectedness of global markets. The crisis led to widespread bank failures, government bailouts, and a severe global recession. It highlighted the need for stricter regulations, enhanced risk management practices, and greater international cooperation in overseeing the financial system. Section 1. The Rothschilds, Architects of Modern Finance. The annals of banking history are replete with tales of powerful families who shaped the financial landscape of their times. Among these dynasties, the Rothschilds stand out as architects of modern finance, their influence extending far beyond the realm of banking to encompass politics, industry, and philanthropy. The Rothschild saga begins in the Jewish ghetto of Frankfurt, Germany, with Meyer Amschel Rothschild, a brilliant and ambitious entrepreneur. Born in 1744, Meyer Amschel recognized the potential of finance to transcend the social and religious barriers that constrained his community. He envisioned a financial empire that would span continents, uniting his 5 sons in a common purpose. Section 2. A legacy of innovation and influence from war bonds to railways. Nathan Mayer Rothschild, a shrewd financier with an uncanny ability to anticipate market trends, recognized the lucrative opportunities presented by financing governments, particularly during times of war. The Napoleonic Wars, which had engulfed Europe for over a decade, provided the perfect stage for the Rothschilds to demonstrate their financial prowess. Nathan played a pivotal role in financing the British war effort, supplying the Duke of Wellington's armies with much-needed funds. His intelligence network, spanning across Europe, proved invaluable in gathering information and moving funds with remarkable speed and efficiency. Section 3. The Rothschilds and the Rise of Global Capitalism, shaping an interconnected world. The Rothschilds' activities extended far beyond the traditional realm of banking. They invested heavily in mining, energy and real estate, amassing vast fortunes and shaping the economic landscape of Europe. Their influence permeated governments, industries and social circles, making them one of the most powerful families of the 19th century. Their story is intertwined with the rise of global capitalism, a system they both benefited from and helped shape. Their ability to move capital across borders, finance large-scale projects and influence government policies made them key players in the interconnected global economy that was emerging. Section 1. The lifeblood of the economy, understanding banking functions. In the intricate web of modern economies, banks function as vital hubs, facilitating the flow of capital, connecting savers with borrowers, and providing a wide range of financial services that underpin economic activity. Their operations, while often perceived as complex and opaque, are rooted in fundamental principles that have evolved over centuries. At their core, banks act as intermediaries between those who have surplus funds, the savers, and those who need capital for investment or consumption, the borrowers. This intermediation function is crucial for efficient capital allocation, ensuring that funds flow to their most productive uses, fueling economic growth and innovation. From deposits to investments serving the needs of a diverse clientele, the modern banking system caters to a diverse clientele, from individual account holders to multinational corporations, each with unique financial needs and objectives. Banks have adapted their services and products to meet these evolving demands, offering a wide range of options designed to facilitate savings, facilitate transactions, provide credit, and manage financial risk. For individuals, banks provide a safe haven for savings, offering various types of accounts tailored to different needs, from basic checking accounts for daily transactions to savings accounts and time deposits designed for long-term financial goals. These deposit accounts form the foundation of the banking system, providing the capital that banks can then lend out to fuel economic activity. The balancing act maintaining economic stability and fostering growth. The role of banks in modern society extends beyond simply facilitating transactions and providing financial services. They play a crucial role in maintaining economic stability, managing risk, and fostering sustainable economic growth. This balancing act requires careful navigation of often competing objectives, balancing the need for profitability with the responsibility of safeguarding the financial system. One of the key ways banks contribute to economic stability is through their role in the payment system. By facilitating the smooth and efficient flow of funds between individuals, businesses and governments, banks ensure that transactions occur seamlessly, supporting economic activity and preventing disruptions. The evolution continues. Banking in the digital age. As we stand at the cusp of a new era, the world of banking is undergoing a profound transformation, driven by rapid technological advancements, evolving customer expectations, and a shifting geopolitical landscape. The rise of fintech, the emergence of digital currencies, and the increasing interconnectedness of the global economy are reshaping the financial landscape, presenting both challenges and opportunities for traditional banking institutions. Fintech companies, armed with innovative technologies and agile business models, are challenging the dominance of traditional banks in areas such as payments, lending, and wealth management. These new entrants are leveraging the power of big data, artificial intelligence, and mobile platforms to offer faster, more convenient, and often more affordable financial services. The enduring role of trust banks as guardians of prosperity. Amidst this wave of technological disruption, the fundamental role of banks in fostering economic stability and growth remains as crucial as ever. While the tools and technologies of banking may change, the core principles of trust, responsibility, and sound risk management remain paramount. Banks, as custodians of our savings and providers of credit, play a vital role in maintaining confidence in the financial system. Their ability to assess risk, manage liquidity, and ensure the security of our financial transactions is essential for individuals, businesses, and economies to thrive.